Hi, I'm Joe Soleil with Federal National Commercial Credit. Welcome to the 7th video in our series, Factoring Costs, the 10 most misunderstood cost drivers. Today we're going to talk about facility fees and minimums. A facility fee is usually a percentage of the line amount or the maximum amount of advance you would be able to receive under a factoring or asset-based lending facility. It's usually expressed as a percentage. For example, a facility fee of 1% on an account where, let's say, you were going to have a $500,000 line to borrow against or factor against. 1% of $500,000 is $5,000 is a facility fee of $5,000. It's usually charged at the beginning of the relationship. Sometimes it's only charged for the first year. Sometimes it repeats every year when the contract renews. But it definitely adds to the cost to your financing. But I think you would have to agree that a $5,000 fee over the course of a year doesn't exactly materially change the cost of financing. What's important is that you know how much that facility fee is going to be and how you have to pay it. I mean, really the big thing about a facility fee is its effect on cash. If you have to pay that all up front, right, or if it comes out of one of your initial advances, then it can be a cash drain if cash flow is very tight. Some factoring and asset-based lending companies will allow you to do that in installments over the course of a year, which eases that. But that's the big issue usually with a facility fee. Let's talk a little bit about minimum fees. Not every factor or asset-based lender charges minimum fees, but many do. They are common. And usually they're designed to kick in when your activity level falls below what you predicted it would be and what the factor expected it would be. Even then, when those minimums do engage, if they operate as a true minimum, you really should only have to pay for the shortfall, the amount that you didn't meet. Our first example here is minimum monthly financing volume. This is when the minimum fee operates based on how much you are financing directly. If your finance volume falls below the stated minimum, this fee provision might specify that you owe the financing fees that would have been charged if you had financed the minimum volume of invoices. Let's look at an example. If we had minimum financing volume of $250,000, that was the minimum requirement, that you finance $250,000 each month. And there was a factoring fee of 1.5% of financed invoices specified in your contract. But your actual finance volume is $150,000, not $250,000. You have a slow month, you didn't do as much work, you only bill $150,000 that month. The shortfall against the minimum is $100,000. So, in this case, the minimum might be the 1.5% factoring fee times the $100,000 shortfall for a total of $1,500 of minimum charge. Now, this is in addition to the 1.5% that you paid on the $150,000 you did finance, but it's not the whole minimum, it's just the shortfall. Let's look at a second example. Minimum monthly fees. Now, in the first example, we said minimum monthly volume. This is just slightly different. It's very similar, but this time the minimum is expressed in terms of a minimum fee charge. If the fees on your financing provided in any month are less than the monthly minimum fee, you would be charged the amount of the shortfall. Let's take an example where the minimum monthly factoring fee is stated as $4,000. And there's a quoted factoring fee of 1.5% of invoices that are financed. And let's say you actually finance a volume of $200,000. $200,000 in invoices are financed that month. At your 1.5% factoring fee, the factoring fees on $200,000 would be $3,000. But your minimum factoring fee is $4,000, so there's a shortfall of $1,000. So you would be charged that $1,000 of shortfall in addition to your actual accrued factoring fees to make up the minimum. So that's the way this example would work. So you're probably wondering, why do we have all of these fees? Isn't this just making it all unnecessarily complicated? And it does get a little complicated. But you'll recall from earlier in our series, I talked about the fact that factoring and asset-based lending companies design their fee structures to correspond to their costs and to ensure that they are going to be able to cover their costs. And with these fees, that principle is no different. It costs a lot of money to set up and manage a factoring or asset-based lending relationship, particularly if it's very complicated with lots of invoices and lots of contracts or lots of customers. So usually the fees that are charged would not cover all those costs in a month or two of financing. So the factoring and asset-based lending companies try with these fees to ensure that they're going to make enough money over time to cover their efforts, to cover their costs, and make a profit for their effort. So that's one of the reasons they're there. Another reason may be if your relationship was brought to the finance company by a consultant or a broker, well, the finance company may have an obligation to pay them a fee, a finder's fee, for bringing you to them. And these fees can be a way for them to cover that cost, that obligation. So in conclusion, factoring agreements may call for a facility fee. And usually that facility fee is charged on, once per year. And you can look at it as a cost that you amortize over the course of a year. Over the course of that year, it's probably not a significant feature in your fee structure. What's really important with the facility fee is the cash effect. Is it going to put stress on your cash flow to have to pay that up front? And very often they are required up front. With respect to minimum fees may or may not have any effect on the actual cost of your financing. It really depends upon the volumes that you are going to deliver in the relationship and how those minimums are specified. If the minimums that are set up in the agreement are below where you expect to be operating in terms of financing volume, then they really have no effect on your pricing. However, if you look at those minimums, the fees that are set up there as minimums, and you're fearful that perhaps you will be striking those minimums on any regular basis, it's important to realize that they could become a very material increase in the actual cost of your overall financing. I'm Joe Soleil with Federal National Commercial Credit. Thanks very much for watching.